Well, welcome to the final episode of our six-part series on 5 powerful tax strategies. And yes, you heard that right again, episode 6 of our 5-part series, because this episode is where we are going to bring all of it together and combine some of those 5 strategies together, Voltron style, to potentially make something bigger and more powerful when it comes to your tax savings. So, the first strategy, we're going to combine 2 potentially powerful techniques: tax loss harvesting and qualified charitable deductions, or as we like to call them, QCDs. So, tax loss harvesting is going to involve selling investments that have experienced losses to offset your gains and therefore potentially reduce your taxable income in that year. Using this strategy, you can generate losses to offset your capital gains and potentially save on taxes inside those non-qualified after-tax accounts. And by taking advantage of the qualified charitable deduction, retirees could donate all or a portion of their required minimum distribution directly to a qualified charity. And so this could eliminate the ordinary income tax on the amount of that qualified charitable deduction. So by combining tax loss harvesting and qualified charitable deductions, you could not only potentially lower your taxable income twice, but also make a meaningful contribution to those causes that are close to your heart. And so then following in that same vein, here is another strategy. And the second strategy is going to revolve around combining the donor advised fund with Roth conversions, making them what I call a super Roth conversion. Now, they are not called a super Roth conversion. I just thought it would be a fun term to highlight the increased amount that you could potentially convert to a Roth by also adding a donor advised fund in the mix. So if you remember our video on donor advised funds, a donor advised funds is a philanthropic vehicle that can provide flexibility and efficiency in charitable giving. And if you remember our strategy of batching multiple years of contributions into one single year, retirees can contribute a significant amount of money to a donor advised fund in one single year, potentially receiving an immediate tax deduction for that contribution, thus paving the way for a potentially larger Roth conversion amount than what they could have done if they did not utilize the donor advised fund. And then they can distribute it to their charities over time. So let's look at a hypothetical example here. And we're going to use Clark Kent and Lois Lane. They happen to have a 6-figure income in retirement. They've got about $60,000 combined for Social Security and about $40,000 in pensions. Apparently, the Daily Planet was a pretty good place to work. And then the required minimum distribution amount is projected to be about $50,000 per year when they hit that required minimum distribution age. But they don't need it. They retired to Clark's farm in Kansas, so they don't really have a whole lot of expenses, but they have to take that required minimum distribution and pay tax on it, even though they don't need it for income. That's the problem with required distributions. They also happen to tithe and give money to charity. They give about $15,000 per year. And most likely, like most retirees, their home is either paid off or has a very low balance left on the mortgage. So even with a $15,000 charitable donation, that's probably still not enough to enable them to itemize because of how large the current standard deduction is. Most likely, like most retirees, their home is either paid off or has a very low balance on the mortgage. So even with the $15,000 that they're giving to charity, they're probably still not able to itemize because of how large that current standard deduction is. And so let's see if there's something that we can do before they hit the required minimum distribution age to transfer some of that account balance to a tax-free account. Okay. So here we are, and this is first what I call their base case. So remember when I said that they've got about 60,000 coming from combined Social Security and 40,000 from pensions. So here is their 60,000 Social Security. Here are their combined pensions right here. And so if you see what that looks like here, you're noticing we've got this gray and red and white screen going on here. And what you're looking at right now is, it says 40,000 right here, but that's just the ordinary income. If you look way down here, I'm going to try to highlight this. The income total is $100,000. The total tax they're paying is about $4,000. So their effective rate is about 4.05%, meaning they're only paying 4% of their income in taxes. So that's a pretty good spot to be in. Now, that's where they are at currently. All right. What would happen if they did a Roth conversion? Now, if you're noticing, they're paying about 22%-ish on their money right now. And so if they convert, they're pretty much going to be converting at 22%. And this right here, these little spikes that you see, these are Medicare tiers. If possible, we try to avoid that, because what happens when you hit one of those Medicare tiers is now Medicare is going to start charging more for the Medicare premiums that we pay. So if possible, we do not want to hit that Medicare tier. And so we're going to work out a plan to convert a certain amount of the Roth every single year that allows them to go up to two, but without passing over that tier. We want to get as close to possible without going over. So what we're basically trying to do is what I call, we're trying to price is right our Roth conversions. Let's go as close without going over. So let's do a Roth conversion. Let's say we do $50,000. What does that look like? Their income went from $100,000 to $150,000 because you have to count Roth conversions as income when you do them. So $50,000 is what that would take. And that is going to create, that's a little more than $10,000 more in taxes, or it increases their effective rate from 4% to almost 10, 9.92. If you see down here, this is where I'm looking. And so here's the new scenario. Then, okay, so $50,000, that's a pretty decent conversion. That's a pretty decent Roth conversion. But they give $15,000 per year to different churches and charities. So if they put that into a donor advised fund, and let's say we do $90,000 into a donor advised fund, all right, and so that's basically going to take care of 6 years of their charitable giving. Okay. And so we do that. And over here, you're seeing that now their income is $200,000 because they've got the $100,000 of their normal income. And then they're doing a $100,000 Roth conversion after their $90,000 donor advised fund. And so here's what that looks like. So their income now looks like $200,000. However, the tax is actually less than what it was with just the Roth conversion. So by putting the extra, I guess, by putting the $90,000 into the donor advised fund, that allowed for a doubling of the Roth conversion with less tax paid in order to do it. And so that's the power of combining Roth conversions with donor advised funds in scenarios where it works well. And it really works well whenever the retirees are charitably inclined. And so that works out really well. And one of the unique advantages of this strategy is that it can allow retirees to take a more strategic approach to their charitable giving while potentially optimizing tax benefits as well. And so, congratulations. By combining multiple tax strategies in your retirement planning, you can potentially optimize your savings and could achieve a more tax-efficient retirement. However, it's always essential to consult with a financial advisor or a tax specialist to tailor these strategies to your specific circumstances. Now, these strategies do offer great potential, but professional guidance is crucial to ensure optimal results. And so I want to thank you guys for joining us in this tax series. And remember, retirement does not have to mean the end of financial planning. It's just the beginning of a new chapter where intelligent tax strategies can make all the difference. So until next time, stay financially savvy.